PowerPoint 13 is on merchandising and inventory systems. I always like this. This is an area where I worked, and I just find it very interesting. Really, I do. Yeah, that was my cat if you heard him cry. Typical merchandising firms today use perpetual POS, barcode reading systems, however you want to describe it, where we have scanners, and the scanners then will create an interface between the accounting and the inventory systems. The inventory system is a detailed record of items that are in inventory, where they are located. It has a lot of attributes, detailed attributes in it that don't really have a direct link to financial reporting, but that it is helpful and it's really necessary to have this information. So when you have a POS type system, you have this interface going on, because what happens is anytime you have a transaction that involves the inventory, you are going to scan those inventory items, and they will automatically then generate journal entries. The inventory database then is a record by each inventory item. The identification for each inventory item is a SKU. That in itself is an attribute. We talked somewhat about this earlier in the semester, and we said if we had a database and we wanted to do a search, we would have a key. That is a way that you could efficiently and effectively scan the whole database, and oftentimes that is the inventory item number. It also shows up on the inventory tag. Sometimes we refer to this as a barcode. Sometimes if you look at the barcode, there's numbers below it as well. So the barcoding just makes it easier for the scanners to read. Within this barcoding system, generally you have a description, a size, maybe a color, and it's all kind of coded into the skewing or the barcoding. The barcoding can be done by the vendor who sells you the items, or you can have your own system of detailing the items. With each inventory item, you should have a retail or an expected selling price. This is important because when the merchandise comes in and gets scanned into your inventory and you receive it, you want to have the tags ready to go. If you have selling price on the tag, then you need to have the selling price in your system. So when the item is received in, the tag can be printed with that selling price. Now, oftentimes retailers don't use the selling price on their tags. I notice Kohl's has displays out. You can look at a display, and the display will tell you the selling prices. Very convenient. You don't have to go around and change the selling price on the tags when you mark things down. This is very convenient, but you still need to have in your inventory database. I'd expect Kohl's to have a retail price that they expect to sell things for. Then also there's cost. Of course, cost does not show up on any sort of an inventory tag that a buyer might sell. This is the cost from the purchase order. Different ways are also, there's different ways of also handling the freight charges and any additional costs that could be attributed to that particular inventory item. But cost is in there. And then the buyer. Why is it important to know who the buyer or the purchasing agent is for the transaction? Well, if the goods don't sell, we need to hold the buyer accountable. So one way in which you look at a buyer or a purchasing agent and you say that person is successful is by looking at the dollar volume of gross profits that are generated, or margins that are generated from that particular buyer, from the items that are sold. So if they have to mark it down and they aren't able to sell it at their total full retail value, then that cuts into margins. So we have to have retail, we have to have cost, and you're going to see in a little bit that we also need to have markdowns and markups, and those transactions, they don't show up in the general ledger, but we need to see that they are associated with particular purchasing agents. Then we also need to know this inventory by location, because we obviously need to say if we have someone in our store and they want to buy it, and at this particular location we don't have that item, we could send the customer to another location, or we could have the merchandise transferred into us, or we could have an idea of how quickly it could get to our store. We have the vendor who the merchandise is purchased from, very helpful. If you see inventory items going low and you need to restock, you need to know who to purchase it from or who we last purchased it from, what we paid for it when we purchased it from them. And then there's the purchase order that's associated with this particular inventory item. I was talking about the database and the markups and the markdowns. We also have markup cancels and markdown cancels. A markup is an increase from that initial retail price that we put in when we establish the inventory item. A markdown is a decrease from that expected price. So if we see things that are selling and there may be shortages of items, I know it sounds a little unethical, doesn't it? But a retailer will mark up. And if things are not selling, they will mark down. These adjustments in selling price will affect gross margin, and we need to keep them by the particular inventory item, so we know who the buyer is that's responsible for these items. If you notice up here by markups and markdowns, I say authorization, because if we sell items and we sell items for less than their original expected retail value, there needs to be a system of authorization in place that determines all of this. So the processes that are happening in these inventory systems: we approve the purchase order. Is the item in inventory? If it is not a current item that we have in inventory, we are going to have to establish a new inventory record. And this inventory record also means that when any transaction is sent through involving that particular SKU or barcode, it will then automatically generate general ledger entries based upon it. So there's some programming there that gets involved. Therefore, it's important for us when we approve these purchase orders and we first start ordering things to have everything set up from an IT processing standpoint. When we receive in the goods, we need to have that tag that's ready to go, because there's no revenue to be generated when you have something in the warehouse. It needs to go out. It needs to go out to the selling location so it can be sold. The invoice itself. There's in the invoice itself, there's no real merchandising impact once it's received in. That's a typical time when we do it. However, as I said before, you might have freight charges, and the freight charges might adjust the inventory cost. So the updates to the inventory database happen when the goods are received in, and when they're received in, they become a part of inventory. There's a general ledger, usually debiting inventory and crediting accounts payable. When we make changes to our purchase order, so that we may be changing the price that we're going to pay for it because it's damaged or something like that, you're going to have an adjustment, and it's going to be an adjustment to the inventory and how much you now owe. So that's a journal entry. When you transfer to stores, this is a very important item here, because oftentimes when you transfer between stores or to stores, people will say, well, it's in inventory. That's all I need to do. No, because you have to take inventory by store location. You are going to need a listing of that particular inventory item by its store location. So when we look at our general ledger, we have an inventory account. Yes, it's listed. But we also have separate inventory accounts by location. So you will be debiting one inventory account by location and crediting another inventory account by location. Well, what happens to the balance sheet? Well, the balance sheet will be a summary of all the inventory accounts, so it's not affected. But the detailed records will be affected. So you need to be sure and note when things are transferred from warehouse to store or between stores. The markups and markdown transactions, there are no journal entries associated with these. However, it goes into the database because we need to make sure we understand not only the items that are selling, but the amount of the markup or the markdown that has to be taken on items, so that when we get future purchases or decide to buy more merchandise, we have an idea of the gross profit associated with it. The gross profit is not just the retail selling price minus the cost on each item. It is the retail selling price that's adjusted for any markups and markdown type transactions. Now, the stores can also make adjustments to selling price. However, these adjustments are not adjustments which are reflected in the general database. These are generally authorizations a store manager might make because, oh, there's a tear in that merchandise, or there's a stain on that merchandise, or something like that. When the merchandise is sold, it goes through the scanner. That one beep generates a lot of journal entries. It takes the item out of inventory, it records cost of goods sold. It records something coming in, either cash or an accounts receivable, records sales, it records sales tax. So the bunch of 2 journal entries, I would say, a lot of accounts are, general ledger accounts are affected by that scan. And when merchandise is returned, you should think of the journal entry for sales as being reversed, because that's really what is happening. At the end of the year, you are going to have to make some adjustments for what they call shrinkage. Shrinkage is when we have theft, and we don't know when theft happens. But I could say this. The thing about theft is theft doesn't go through a point of sale device. No one's taking theft through the register scanners. Okay, so it doesn't go through a register scanner, then inventory is not reduced. That means the database is off. It also means our general ledger is off. So at the end of the year, yes, you have to somehow make adjustments which adjust both the general ledger through journal entry and adjust the specific inventory items. Authorizations happen in inventory. This is a part of internal control discussion, and you see it within your chapter in your reference. I think it's chapter 6. But the purchase order itself has to be agreed upon, and as we said before, there's responsibility for that also in the particular buyer, who's the one that's responsible for those inventory items. Markup and markdowns, you can't just take markups and markdowns. And in a lot of cases, it's the buyer. The buyer has to take responsibility for markup and markdowns. And a lot of markdowns would need to be approved by persons, supervisors, and higher level than the actual buyer. The transfers between stores, you really want to limit this, because if you transfer merchandise between stores, what do you incur? You incur freight charges. So you've cut into your profits right there. The store adjustments to sales price, this varies within retailers, whether they're going to let their assistant managers handle it, whether they'll let their clerks handle it, how all of it is handled. But you should have some authorizations there, because that is an area where fraud can occur. So authorizations then are important in inventory. We need to keep the authorizations, the record keeping, and the custody separate so that there's no conflicts. The documents should be, a lot of them, generated and relied upon the scanning technology, which hopefully makes it accurate. Sometimes you'll have systems where journal entries are required. You need separate security systems, security for the warehouse, because you're talking about custody, and that custody being separate from record keeping and authorizations. The inventory database in itself has to be kept clean, because if it's not kept clean, it's not kept accurate, then it affects the decisions that are made, which affects your profitability. There needs to be some verification that things that are transferred in and out between locations match up. We do not want to see negative balances in the quantities of merchandise. We do not want to see negative values in inventory by location. Periodically, you're going to be looking to see that if your inventory records at a particular store say you have this many items on hand, you actually have those items on hand. What the retailers will do, the clerks at locations, is they will look in their inventory system, and I'm sure you've had this done. You'll say, I like this item, but I don't want a medium, I want a small, or I want a different color, I want a different size, or something. And you'll ask them to look in their inventory and see if they have it. This is a time where that particular individual at that retail location can get a feel for whether their database is right or wrong. Because if their database is wrong, that is, the inventory that they see is not what is actually in the database. What they physically see does not agree with their database they show on their screens. Then probably their general ledger for that store is also off. Periodically, we should be checking those markups and markdowns to make sure that they are all authorized. Again, it's a potential for fraud. It's also a potential to lose your gross profit.